I'm going to go ahead and show you slaughter steer prices, and uh, the thing that we're seeing right now is a really big uptick in live cattle. Uh, we've increased net revenue in the past 2 weeks by probably $150 to $160 a head. That's net revenue, which has put live cattle profits in the 160 to 170 range. The same, very similarly, we've already had a little over 5,000 head of cattle trade this week at 124. So steady with last week, and the break even is about the same. It's a touch higher than what it was last week, but cattle feeders will continue to make about $160 a head profit this week, trading at 124. So I expect that to fully be steady this week, as we've seen the futures run up the past 2 weeks, and it's kind of leveled off the past couple of days without any major changes. I'm going to fast forward this to feeder cattle prices, and last week we had several loads of feeder cattle sale in the 800 to 900 pound range, and those cattle averaged, for the most part, about 157 to 160, which is a very, very strong basis value for our state for this time of year. And basis just being the cash price minus the futures. So we know that in general, this is a weekly auction market price, and what I'm telling you about is load lots of feeder cattle, and I'm going to use the basis on that. Generally, this time of year for 8 to 9 weights, we're usually looking at cash prices being $12 back of the November futures market. And right now, that November futures is somewhere near the 160 mark. So if it's near the 160 mark, and we usually have a negative 12 basis, that would put us down at 148. But we had a lot of cattle trading in that 155 to 160 range last week. So our basis is 7 to 10 to $7 to $10 higher than what it normally is, or stronger, I should say, which is very beneficial for our producers selling cattle. On top of that, the break even on those cattle going into the feedlot is probably based off of some back of the feed sack type math that I've done with it this week. We're probably looking at 118 to 121 on the break even of those cattle coming off of feed in April, late April or early May. That would be having feed. Well, I guess late April would put cattle on feed 170 days or so. So thinking about that, if the break even on late April is 118 to 121, and that April contract is actually trading closer to 126, that would tell us that there may actually be a few more dollars in that feeder cattle market that aren't being fully priced in right now. I'm very hesitant to say that, but looking at what live cattle prices are on the futures market and what we're expecting in the spring right now, we have a very, very we realize we have a very, very strong feeder cattle market, but there is potential for that market to be just a touch stronger than what it is. We're only talking about a couple of dollars a hundredweight, but a couple $100 goes a long way. To back up one to the 500 to 600 pound steers, I remain surprised at this, and y'all, and a lot of y'all heard me say this last week, but I'm very surprised at the lack of following the seasonal pattern this fall, the seasonal pattern that we've had, we've had a very seasonal pattern all the way up into September, and since September we've had a very, very steady market for these calves, and that's a very good thing for a lot of our producers that sell calves straight off the cow. A very positive thing for them. It may not be as positive for people that are trying to buy cattle right now, as far as stocker producers that try to source cattle during the fall to carry through the winter and sell in the spring sometime or in early summer. But things are looking very, very strong as we currently see it. For those that didn't see this last week, I think it's very key for us to point out where we are on slaughter rates, and the point of this being that we have heifer and beef cow slaughter that's up 12% and 10.5% respectively. This does not mean we're reducing the cattle herd size. We're just getting back to a fairly normal slaughter rate for maintaining a herd size about the same. So when January 1 rolls around and we see that cattle inventory is up slightly, that's what we expect is maybe a 0.5% to 1% higher cattle inventory, and these slaughter rates are likely to persist similar next year as to what they are this year, and that'll be a lot to do with the fact that we've had really, really strong cattle prices, and people aren't going to be looking just to move a lot of animals out with the prices that we've been seeing and how strong they've been. But this does lead to more meat production, beef production being up 4%, pork up 2.8%, and broiler up 1.2%. These numbers were a little different last week when we went over them in in-service training, but not much different. We've been blessed with a strong export market, and I'm fixing to have some updated information for the most recent. Friday was the most recent release on monthly export and import data, and it looks very positive. It actually goes right along with some of the things I said. The numbers came out correctly, thank goodness, and it kind of backs up some of the things that I said last week in relation to imports and exports and how strong exports have been, and the expectation that imports would decline as Australia continues to get a few rains. So let's go ahead and look at that real quick. You can see imports have declined significantly the past 2 months. The September data just came out on Friday, so that last data point it should be new to most everybody on. And for those that hadn't seen it, we had several issues that played to those imports increasing in that May, June, July time period, where the Australia, New Zealand area, mainly Australia, was suffering from some drought issues that forced them to sell cattle that they didn't plan on selling that quickly. And as they continue to rebuild their herd from a drought that occurred year and a half ago, those imports will be fairly small. You can mark there that note that we only imported about 230 million pounds, as opposed to the fact that we actually were a net exporter for beef in the month of September. That bodes well for the market. We have a really, really strong market to Japan right now. The markets to Canada and Mexico remain fairly strong, and to North Korea. So those 4 markets are very, very strong. I'll back up to again, we're still working on that China market. Sometimes it's a fickle market to deal with. I was actually just reading some information within the past couple of days on the market to Europe. That's going to be an important market. A lot of what we send to Europe is high quality middle meats. The problem with Europe is a lot like the problem with China, is there's a lot of restrictions. The EU does not allow growth promotants or growth implants in beef that's coming to being imported by the EU. We use those technologies frequently and to our advantage in this country. And so we only have a limited amount of cattle that meet that market. And the thing is you have to receive a premium on cattle that do not use a beta agonist or a growth implant. Those things are key in the economics of what we're doing when we're feeding cattle. And so to relinquish those and set those off, take those out of the toolbox per se and put them on the shelf can really hurt. And so we have a limited number of cattle feeders that are trying to meet that market. And those same cattle fit into the China market pretty well because they have very, very similar requirements. We went over the JBS Brazil deal. We went over pretty heavily in the in-service, the TPP and the NAFTA. And if there's producers on the line, or if there's producers in your offices right now, I think most of y'all would feel pretty comfortable talking about those two things as heavily as we went over them last week. But just know that there's still some struggles in both of those, and we really need to start working on some agreements with NAFTA especially, and some bilateral agreements with some of those Asian countries and island countries out there. I will say that packers are sitting in wait, hoping that boxed beef prices start to escalate in a hurry as they've started to having to pay a lot more for cattle. We'll see how that progresses. Again, it's always prudent to show the drought monitor. I will make note, the most important part of this may be a lot of parts of eastern Texas where we depend heavily on winter annuals in that area to grow stocker cattle, which also supports the demand on our cattle. They've had some dry conditions and some extremely or above average temperatures, which what that has resulted in has resulted in delayed plantings in some, sometimes we're too wet, sometimes we're too dry. And actually a lot of this year we've been too warm. And the reason for that is army worms continue to be a problem. And so a lot of these people, when it's a little dry and there remains an army worm problem, they delay plantings. Number one, because they don't want to incur the cost of having to spray for those insects or pests. And so a lot of those people have not got winter annuals in the ground. And so that's going to delay the ability of those producers to actually purchase animals. It's pretty widespread in the eastern part of Texas, and the thing is when you look at the eastern part of Texas, it's the same size as our state in whole. So it can have a huge implication on those animals. I'm actually going to be driving. I wish this meeting would have been maybe next Wednesday, because I'm actually going to drive through a big part of Texas in the next several days. Going to cover a lot of ground and see a lot of things, I hope. And so if you have questions on that, maybe next week you can always give me a call or shoot me an email. And if you have if you want to have a boots on the ground type of feel, I might be able to provide that, because I'll be covering a lot of miles in the next few days as far as wheat country is concerned in Texas. I tell you, this would be an appropriate time talking about pastures being in good condition locally and nationally. And I think I discussed with Kevin Rose at one time earlier, maybe late last month or something. For people that have producers that may be considering pasture, rangeland, and forage insurance, the sign up, the deadline to sign up is November 15th, which would be next Wednesday. I'm currently putting a focus on forage risk management, which includes the pasture, rangeland, forage insurance in my master beef classes. I think that is beneficial for our producers. I've been trying to do several of every one that I've had this fall. That's what I've focused on, realizing that it'll be too late by the time I do any more of them. It'll be too late to sign up for this year. But I do think that's a program that can benefit a lot of our producers as they consider how to manage risk in their cattle operations. You know, we can manage price risk with using futures and options and livestock risk protection insurance. But a risk that people may feel a little more comfortable managing would be their forage needs, and using PRF insurance may actually be something that people may feel comfortable with, and it may be a good deal for them. But anyway, I want you to know that November 15th is that sign-up date. If you have people asking questions, we have several people that sell that insurance across this state. I'm not going to sit here and promote any one person, but if you need me to put you in contact with or give you certain people, I'll be more than glad to do that over email or through a phone call, or show you where you can look for people in your area for that. But anyway, we'll carry on. Won't spend too much more time on that. The latest data coming out of the Kansas feedlot, about 75 cents of feed cost to finish cattle in the feedlot. That's what I used when I was talking about finishing cattle being a break even. If we're putting these calves out there, being bought at 155 to 160 is 8 to 850s. The break even on them being 118 to 121 was using a cost of about 75 cents for a cost of gain. There'll be places in Iowa where farmer feeders are feeding cattle that you might have a cheaper cost of gain than in Kansas. Now, realizing that cattle in Iowa may go through a little bit tougher winter than those in Kansas, they're both going to be pretty tough regardless. But using about a 3.2 average daily gain on those cattle is how I came about that 118 to 121 break even. But the thing is feed costs are low, and I don't think Aaron showed anything that would indicate feed cost escalating anytime soon. So I think we'd have a full feeding period of any cow that entered the feedlot now or between now and the end of the year that wouldn't have to worry too much about escalated feed costs, even as that new crop's put in the ground. This is March feeder cattle futures at 157.35 is where we closed. A very strong move the past 2 weeks, which was all in following the live cattle market. So if that live cattle market starts to soften, these feeder cattle prices will as well. But I do think there are some opportunities right now for people that want to hedge cattle. Hedging these feeder cattle at this 157.35 mark is not a bad idea. I don't know that I would use a straight hedge. I think using a minimum price contract, using a put option, I think there could be some benefit in some producers doing that right now because there are definitely profits to be made at that level for that March time period of sale. Similarly, the May contract is very similar, nearly just shy of 157, and there should be some opportunities to hedge some cattle there. for stocker producers, those calves may not even be bought yet, but sometimes it doesn't hurt to go ahead and price them before you buy them. And if you're buying them out of the sale barn, our basis remains like it is. And again, when you go into that March and May time period, we're looking at, I think, anywhere from a -11 to -14 type basis. It traditionally. But right now, if we stay at a -3 to -5 basis, we're talking about strong prices and really good profits that can be hedged in the current market. Y'all saw this last week. Still really strong values of gain that are expected, and even if prices fall tremendously, we can still remain profitable based off of current weekly auction market prices. It's just you have to remember to figure in the risk of morbidity and mortality. Morbidity, of course, can be really high with those sale barn cattle, and then sometimes we run into those wrecks where mortality becomes a terrible issue. I talked to a producer Monday night who just he told me that he bought into the first set of sale barn cattle he's bought into in 2 years, I think, or maybe 3 years, and he's had them for 6 weeks, and he's only treated 4 out of 67 or so. So he's had very, very good luck, you know, for cattle that were bought in late September and brought in. We realized, I think people understand that October is a terrible month a lot of times on morbidity of freshly weaned calves because of those big temperature swings that we have, and we have had some very, very large temperature swings. So with that,